Alright, so this is credit derivatives, lecture number 3. And we're going to have 3 lectures on chapter 2. So, chapter 2. Market structure. Is it, guys, going to be better to turn off this light? At least for the camera? Huh? Market. So all we're going to be doing here is just tell you what the market is and how the market, meaning the derivatives market, is and how it works. This is on page 24. And then I got 2, 1. And 2, 1 is development. Oh, the guy wanted bigger, right? Development is in history. Alright, so review, only review. First is the concept of option. And we are here discussing only option markets. So option is the right but not the obligation to buy or sell a particular security. The option then is call option. Which gives you the right to buy and sell. Option. The right to sell. The next review concept is the strike price, which is the price at which you have the right to buy or sell, and the premium. And the premium is the price of the option itself. And sometimes we call it premium price. So premium is simply the price of the option. And the last concept, the concept of maturity, is known as the expiration date. Expiration date. Expiration date is the date on which the option expires. To expire means it is no longer valid. To expire means to lose the right. In other words, expiration is like the end of the option. The end. Alright, here is the kind of like the same as the death. When the option dies, when it becomes invalid. Alright. So, part of the development of the history is, back in the old days, they called themselves put and call brokers. And these are brokers or dealers of puts and calls. Brokers or dealers of options. These are just a bunch of guys or financial institutions that got themselves together, associated, and they made themselves an organization which they called put and call brokers in the United States. when I'm talking about the history here, I mean modern history as of 20th century. Back in the old days, in Roman times, there is a record that 2,000 years ago in Rome there were derivative markets. Later on in the Netherlands, the Dutch had so-called tulip mania, in that futures and options on tulips, on the commodities. So you have historical record of certain markets, but the modern day derivative markets begin with the put and call brokers and dealers association. And let's clarify to make sure that everybody understands the basic concept of a broker. Broker is an intermediary between a buyer and a seller, as in a real estate broker. The broker does not take position. The broker never owns the asset. The broker works for a commission. And a commission is a, let's write it out, commission is a percentage of the sale price for helping the transaction. So brokers work for a commission. And then you have dealers. Dealer is someone who holds inventory and who provides a bid, which is an offer to buy, and bid offer or bid ask, which is an offer to sell. So the dealer at any point in time, you can go, and if you want, you can buy, if you want, you can go and sell, okay? Any little exchange bureau over here, when you walk in, you want dollars, they'll sell dollars, okay? You want to, sell dollars, they'll buy them. So at any point in time, they will be buying and selling, and they're going to have a bid price and an ask price, okay? So this is how dealers work, okay? And in 1973, these guys decided to organize or to open the first modern day options exchange known as the CBOE. CBOE, which stands for Chicago Board, let's make sure that it's Board, yes, Board Options Exchange. Notice this is exchange which is devoted specifically to options, and it's based in Chicago. 1973 is the first modern day options exchange market, okay? Organized market. Let's see what we got. One of the big innovations of modern day exchanges is the clearing house. Sometimes clearing house is one word, sometimes it's two words. British English, two words. American English, one word, okay? So, a clearing house is a special institution which clears trades between members. To clear means to offset. If you have a long position of an option and at the same time a short position of the same option, they will offset them and will become 0. So you got a long, you got a short, they cancel each other. So at the clearinghouse, they will cancel all the contracts which are opposite to each other. So the clearinghouse will use only the net or the offset position. Okay, that's a very, very important innovation I'll be discussing later on. Now, the main role of the clearinghouse is effectively a guarantee. It is a guarantee that the other party will perform on the contract. Let me explain this trick. When I buy a call and you sell the call, you don't sell the call to me. It doesn't work like that. You sell the call to the clearinghouse and the clearinghouse sells the call to me. So when I have a problem, I deal with the clearinghouse, not with him. Okay? And then when you buy the contract from him, I deal with the clearinghouse, and he deals with the clearinghouse, and you deal with the clearinghouse. So the clearinghouse is the counterparty to every single trade and every single position. So if something goes wrong with you, it is not your responsibility and it is not my problem. It is the problem of the clearinghouse. Okay? So when someone else, when you make a futures trade, okay, and for example something can go wrong with you and you cannot perform on your contract, we call this type of risk, let me write it out here, counterparty risk. Counterparty risk. Counterparty is the other side of the trade. For a buyer, the counterparty is the seller. For the seller, the counterparty is the buyer. The counterparty risk is the risk that the counterparty will fail. The counterparty can go after 6 months bankrupt. Or the counterparty may refuse to pay. Or the counterparty may go to the court and say the contract is invalid. In other words, the counterparty risk is that the other party, the counterparty, will not perform on the contract. Well, the clearinghouse becomes the counterparty to all transactions, and now my risk when I'm buying and selling is not you, or you. My only risk is the clearinghouse, and your risk is the clearinghouse. So now the clearinghouse absorbs all the counterparty risk, okay? And the way to ensure that the clearinghouse will perform on its obligations is, how do we ensure that a bank can fulfill its obligations, that a financial institution can fulfill its obligations? How do we ensure that? You guys study financial institutions? Right? So how do you know that a bank will have enough assets to satisfy its liabilities? How do we know?
Reserve.
Again?
Bank have reserve requirements.
Bank have reserve requirements. How do we call these reserve requirements? Alright guys, this is,
what we call
again,
um,
come on,
how we call the bank analysis นะครับ
again,
analysis
now, how do we call this thing? No, it's not a reserve requirement.
margin maintenance margin
Alright, I'm beginning from the beginning, okay? For like first class in accounting, alright? You have a financial institution which has obligations, and it will meet these obligations with assets. And you want to make sure that the financial institution has more assets than liabilities. So we need the difference between assets and liabilities and obligations. How do we call the difference? For any financial institution, for any business, capital. So, risk for a bank, risk for insurance company, risk for any financial institution is managed or absorbed with capital. And capital is the same as owner's equity. I think next time we'll begin with a little written quiz just to see basic stuff like, basic finance which you studied last year, just to make sure that you know things like what is interest rate, what is capital, what is bank, what is money, right? So we see that you actually know. I mean, everybody, you guys study capital, right? In every single course. Capital is one of the most important concepts in finance, okay? So, risk is managed by capital. So, the clearinghouse will have a capital of its own. The clearinghouse will have capital, and that capital will provide a guarantee that if something goes wrong, the clearinghouse has the capital to cover the losses. Okay? Right? When it's an elementary, you study elementary accounting, right? When you have a loss, the loss goes in the capital, right? With a negative sign. So, in order to take a sufficient loss, you need to have a sufficient capital, okay? So, capital absorbs losses, okay? That's a fundamental concept for any financial institution, for any business, okay? The capital keeps you going. So, that's what the options exchange does, okay? The option exchange got a clearinghouse, and the clearinghouse will provide a guarantee, and the guarantee will be by the capital of the clearinghouse. So the clearinghouse will have its own capital. Okay. So from 1973 to 1987, the derivatives market had a huge growth. Growth was almost exponential. Growth was geometric. It grew rapidly until the 1987 stock market crash, where the stock market crashed like never before, 20-25% in one single day. And the stock markets crashed practically everywhere in the world. They started crashing in New Zealand, and then in Japan, and then in Australia, and they just started crashing all around the world, okay? And as the markets began to open in Europe, things were going from bad to worse, and then to London, and finally the crash was worst in the United States, okay? And then it was understood that derivatives played a major role in the stock market crash, where portfolio managers did what was known back then as portfolio insurance, where they did, it's called dynamic hedging, where as the market falls, the strategy required that you sell more to hedge yourself. And as you sell more, the market fell even more, you have to sell even more. And it's a never-ending crash. The more it falls, the more you sell, and the more you sell, the more it falls, and it was a vicious spiral that ended up in a complete disaster. And it was understood back then as well as now that derivatives were at the root of this spiral problem on the way down. And after 1987, derivatives weren't used as much. The market was not as vibrant. People understood that you can get burned with derivatives real bad, and that you think you may be protected. Well, in reality, you're not, because the market freezes on you, because the market does not become liquid, because the market did not perform the way it was designed in a critical situation. So, not after 1987, the options market slowed down significantly, and over time, in about 97 onward, the derivatives market began to pick up again. With the technology boom of the late 1990s, suddenly stocks were hot again, and if stock market is hot, this definitely means that speculation of stocks is hot, and this means that derivatives, and especially calls on stocks, will be hot, because that's a better and easier and cheaper way to speculate. So, speculation in the stock or technology.com telecom bubble of the late 90s led to another explosive growth of the options market. Okay. Section number 2. Call. Let me make sure. Call options. All right. For call options, I already covered the exercise. The exercise price. The price at which you can buy the stock or buy the commodity, okay? This is the exercise price. Let's see what else we got. Stock options. And options can be in the money and out of the money. You studied this already? Okay, in the money, in the money option, and out of the money. In the money is an option that brings revenue when exercised at the moment. In other words, an option is in the money if the current price, P0, P stands for the price, 0 stands for the price at the moment, times 0. So we can write P, T equal to 0. The current price is greater than the call price. So, for example, the current price is 125 and the call price is 110. You can exercise the call at 110, sell at 125, and you're in the money 15. Okay? And you're out of the money when the current price is less than the this is not the call. This is the price. This is the exercise price. Yes. The exercise price. The exercise price. Okay? So when the price currently is above the exercise, you're in the money. When the price currently is less than the exercise, you're out of the money. Let's see anything else that's important. Okay. Next one. If the price of the stock goes up, what happens to the price of the call? What happens to the value of the call? So, currently, let's say if the price is 125 versus 110, when you exercise now, you're in the money 15. But if the price goes up to 135, you're going to be in the money 25. So, the call is worth more when the price goes up. So, when the price, this arrow means going up. Okay? We don't do it like this, we do it like this. Then the call, the price of the call, the same as the value of the call goes up. So, it is a fundamental relationship that the value of calls increases with the price. Let's see what else we got. When the price of the asset is, here it's greater than, here's less than. If it's equal to the exercise price, we say that the option is at the money. Wow, you studied so much, okay? This is easy stuff for you. Move on. 2, 3. 2, 3. Put options. And put option is the right to sell an asset at the given time, or before the expiration date at a given price called the strike price. We have exactly the same concepts of in the money, out of the money, and at the money. And in the money is, a put is in the money when what?
Price go down.
When the price, we say current price is
Lower
less than
the exercise.
the exercise price. Here, when it's greater than the exercise price, in here, when it's equal to the exercise price. Okay, that's 2, 3. These are small, easy sections, but there's a lot of them for today. Number 4, over-the-counter market. over-the-counter market. Today, the over-the-counter market dominates. It means that derivatives started their early days before the options exchange opened as over-the-counter markets. As the option exchange opened, the options market, organized market grew, and the over-the-counter market shrank. After the 1987 crash, the over-the-counter market began to grow much faster, and now the over-the-counter market is still larger than the exchange market. Okay, so the over-the-counter market today dominates. The second key concept which relates to over-the-counter market is called credit enhancement. Counterparty risk, which I explain over here, where the other party may not perform, is in general known in finance and called credit risk. It is a type of credit risk. Okay? And credit enhancement is a risk management tool to reduce credit risk. Well, the question is, how do you reduce the risk? In other words, how do you enhance the counterparty risk? How do you lower it? Well, the answer is with a guarantee. So, what's the guarantee? The guarantee is called collateral. You studied already collateral? You know collateral? Collateral is an asset which guarantees a loan or guarantees a credit transaction. If the obligation is not fulfilled, the creditor, if the borrower does not fulfill, the creditor can take the collateral. Okay? In a mortgage, remember, we say that a mortgage is guaranteed by real estate. We say that a mortgage is a loan collateralized by real estate. In other words, in a mortgage, the collateral is the house, is the real estate property. So here, you will have a credit enhancement by the obligating side posting a collateral. So, they say, okay, well, here are a whole bunch of bonds. If something goes wrong, you can take the bonds, okay? So, they'll be posting collateral. And the collateral will be a guarantee if something goes wrong that the other party has something. So, collateral will reduce the counterparty risk. Okay. The big advantage of over-the-counter market is that the contract is customized. You can specify your delivery date whenever you like. You can specify the delivery contract wherever you like. You can specify the delivery location wherever you like. Okay? So you make it just the way to suit your needs. So customized is the exact opposite of standardized. Standardized means everybody using the same contract. Here is, we're going to make our own contract. You want it for July? Okay, for July. You want it for 7 tons? Okay, 7 tons. Okay, you want it delivered in Bangkok? Okay, in Bangkok. Or in Singapore? Okay, Singapore. Okay. So the big advantage of over-the-counter market is that the contract is highly customized. Okay. But if Singapore is perfect for you, Singapore is not good for you. And you don't like delivering in Singapore either, right? So here, the problem with the customized contracts is that they're not liquid or illiquid. Illiquid means not liquid. Not liquid means not easy to sell and not easy to cancel. When I was explaining here, in the clearinghouse, when you buy a contract which you don't want anymore, you can sell the contract after 1 week. And when you sell the contract after 1 week, the one long contract that you have and the one short contract that you have, they cancel each other. You have no more obligation. Here, you can't sell it to anybody, your illiquid contract. Your illiquid contract is very difficult to sell. And there's one other problem. The other problem is that if you actually sell it, the long contract does not cancel the short contract. You have a counterparty risk on the long side, and you have another counterparty risk on the short side. So I have the contract with you, and I have a long contract, and I have a short contract with you. Before, I'm taking one counterparty risk with you. Now I'm taking 2. I'm taking risk with you that you may not perform, but I'm taking risk with you that I may not perform. In a clearinghouse, you cancel each other and I'm out. I'm risk-free. Now my counterparty risk has doubled. Okay? So the problem with the over-the-counter is that you do not, when you sell or when you buy, you have no offsetting. No offset. Now you have 2 obligations. You have an obligation on the long and an obligation on the short. That's a big, big, big disadvantage. You can't easily get out of your position. The only way to get out of your position is whoever your counterparty is to make a second contract to cancel the first. And your counterparty may want or they may not want, okay, to let you out. If they think you're going to lose a lot more money, they'll just stay and say, no, we don't want out, okay? So that's a big, big, big disadvantage. The illiquidity is another major disadvantage, okay? But the big advantage is customized, okay? Let's see what else we got. Okay. Part of the customization is that over-the-counter market allows for bigger and more varied underlying. You can have an underlying on cheese, or can have an underlying on soy, okay? You can have more underlying types, okay? You may have an underlying on rain, okay? So, in the futures market, the underlying is standardized. For example, I'm just picking a number. Right now in Thailand, you got only 17 contracts, futures contracts. And I got only 17 choices for an underlying. In over-the-counter, you can tailor the underlying to be anything you want. You may just pick 5 stocks at the same time, okay? You may pick some stocks and some bonds, okay? You may pick very many different things. You may pick some real estate prices. So in an over-the-counter, the underlying could be very, very different. Much bigger choices. Let's see what else we got. The major disadvantage is the credit risk. The major disadvantage of over-the-counter is the credit risk. But it is mitigated, it is reduced by the credit enhancement. Credit enhancement is a tool to lower the credit risk. Here, credit risk is exactly the same as counterparty risk. Okay? Let's see what else we got. One of the major disadvantages of over-the-counter market is unknown size. So it's a private market. You can get 2 banks to make a deal. They don't have to disclose to anybody. It's a private market. And if it's a private market, you don't know what's going on. And therefore, unknown size. You don't know what's the size of it could be big, it could be small, you have no idea. And they don't have to tell you because it's not public, because it's private. In other words, the over-the-counter has the problem of limited information. Limited information is the same as coming out of the private. Limited information. And here is the good news, right? Finally, the good news. The good news is that valuation of over-the-counter markets, over-the-counter instruments is the same as exchange-traded instruments. In other words, valuation is the same. In other words, the value of an option traded on an exchange is the same as the option traded over the counter. So, an option is an option, and it's valued in the same way independently of where it's traded, whether it's traded in Japan or Tokyo or privately between 2 banks on over-the-counter market. Is that fairly clear? All right, 10-minute break.